welcome to the presentation today on the Mercedes-AMG HVP pension scheme. We hope you find the content useful. There's approximately 11 slides, so hopefully it will run to around about the 30-minute mark in terms of total content. Any questions that you do have that aren't answered in this, please let us know and we'll get all the information back to you as soon as we can. For those of you that I haven't met before, my name is Mike Savage. I'm a financial planner with Warren House Employee Benefits, and I'm a corporate pensions specialist. In the context of this presentation, I'm here to talk about salary sacrifice, and as a financial planner, I can give advice on pensions, savings, investments, mortgages, protection, medical insurance, tax planning, pretty much everything and anything to do with the financial services industry. If I don't know the answer myself, then I normally know somebody that can help point me in the right direction. So please do ask any questions that come off the back of this specific content, but also any areas of your wider finances. Very happy to help where we can, myself or a member of the team. There's also a few useful links on here to the Aegon pension scheme, which often people do ask about, specifically how to get online so that you can see your plan. That's really important to keep the data present, current, but also that's where they will upload your annual statements too. So please do have a look at getting online if you're not already. Also, there's a short video guide there on how to change your investment funds within your Aegon pension. Again, very useful if you wanted to alter the current risk settings that you've got. And if you would like any advice or support on that process, please do let me know. There's also then a link to the Aegon specific fund range for your pension plan, so that when you are deciding to make any fund switches, you actually have the list of everything available to you. It's quite a broad list, so please do shout if you need any support there. But hopefully this presentation will be useful. If you have any questions, do let us know. I've got the contact details later on through this, but also then you've got our website there, so the cswm.me.uk/Mercedes portal. That's your specific Mercedes pension portal. So if you click on there, there's a load of useful information, including how to book time with us, get our full contact details, answer some additional questions, and we'll also be seating a lot of this new content on there as well. So please do visit there as your first port of call, and then we can make sure that you get everything you need. So I thought it'd be useful here to give you a reminder of the pension scheme itself, who manages it, where it's placed, who's it invested with, etc. So from that perspective, you've got Aegon as your pension provider, and this is a group personal pension, which is effectively an individual bank account that is tax-free, growth, tax relief on the way in, and tax efficient on the way out. But it's a group personal pension which has an individual account in your own name. So although it's managed by Aegon underneath the Mercedes relationship, so you get economies of scale and discounts on the charging shape, it's an individual account that you fully control. It's very good financial strength rating as far as Aegon's concerned, with Standard & Poor's at A+. It's probably one of the better ones within the industry at the moment. It's a really good, they've been around in the industry for a long time, committed to this kind of pension investment scheme as well. Actually one of the biggest group pension providers in the UK by market share. So hopefully they'll give you the comfort there that they're in it for the long haul and will do a good job to look after your money. There are over 200 investment funds available to you across all the major asset classes. The default option, which is where you'll be automatically enrolled as a new joiner, is the Fidget Fund, as it's called, which is a 50% fixed interest, which is lower risk assets, and 50% global equities, which is the slightly higher risk assets. So it gives you an overall balanced approach to your investment. Now, hopefully that will suit most people, but there are other alternatives in there. If you wanted to go slightly higher risk, for example, we also curate two other portfolios in there called the growth option and also the adventurous option. And that takes you from the Fidget Fund that has around 50% risky assets, or the equities as they're known, into around 75 to 85% in the balanced lifestyle and 100% equities in a dynamic lifestyle fund. So this is a great way to very quickly ramp up to high levels of risk should you wish to do so. And often that is really attractive for people with a long time before they're going to retire, because generally speaking, history has demonstrated that the higher risk funds on average do perform better than the lower risk funds. Obviously that is not always guaranteed, and past performance isn't necessarily a guide to future returns, but if you look at the long-term averages, the investment returns generally have outperformed in the high risk funds. There are also lots of other funds within there. There's some specialist funds, maybe if you wish to have something a bit more ethical, or if you have religious preferences. There's a Sharia fund in there, for example. There's also zero risk options in the form of cash building society style accounts. So do have a look at the investment funds, see what might suit you, and if you want any support at all, let us know. It will help guide you to the right places. The best way to operate your pension scheme is through the online access, and that gives you quick viewing information on the policy itself, but also how the investment funds are doing, what contributions you have going in each month, and also a projection of what you might get back at retirement. Also, under the Make Changes tab within the online portal, you can follow the guide to get you switching investment funds, but also keep up to date with your addresses and if your mobile number change, your email address, all that kind of stuff. So it's a very useful protocol to get some information out of the system, but also put some information in. So please do have a play with that and let us know if you have any issues. The group pension scheme itself is, as I say, your entire pot to control. So do get in touch with that. Make sure it's customized to you. And if you need any help playing with that or changing, let us know. The level of income in retirement is fully dependent on the size of that fund, the annuity rates at the time, and also your health at retirement. So the bigger that pot is, ultimately, the larger the pension income you will receive in retirement. So it's quite important that you don't necessarily have to look at it day to day, but getting engaged earlier on has been proven to have a significant impact on your pension in later years. So it's a good thing to have a look at. There's also full pension flexibility available. So if you got to age 60 and you wanted to cash the entire fund in as one lump sum, you can do. There's lots of options within Aegon, and also you can move it to a drawdown pension or to buy an annuity at retirement. So there's lots of options. It's very, very flexible and hopefully very easy to manage. But if you do need any support, let us know. Also on there, the annual management charges are included low at 0.2% per annum. So if you've got £1,000 in there, that's £2 a year to run the pension scheme. Hopefully the investment funds will be growing at 5, 6, 7, 10% a year even on average over a longer period of time. So a small amount of that pays the charges, and then the rest of it will be the growth that you receive within the investment funds. So hopefully it's a really attractive pension scheme, but as I say, the key message there is do get involved with it, have a bit of a play, and ask any questions that you might have to customize it to your needs. Moving on to the focus of the presentation today is the introduction to the new salary sacrifice pension. And ultimately, this isn't actually physically changing the fundamentals of your pension scheme. It is actually a change to the way we contribute money from you into the pension scheme. So Aegon's staying the same, the investment funds are staying the same, the charge is staying the same. This is just merely a way of altering the payroll processes to try and make your contributions to the pension scheme more admin and, most importantly, more tax efficient. So I'll explain a bit more detail around here. There'll also be loads more content coming at you over the coming weeks, so do have a read of that, formulate any questions, and then we'll make sure that you get all the information you need going forward. Salary sacrifice is quite a common term nowadays. You may have heard it in various other forms, from childcare vouchers through to a bike to work scheme, or tax efficient car schemes for eco-friendly electric cars, etc. But in this context, salary sacrifice, or also known as salary exchange, is a more tax efficient way of making pension contributions. So at the moment, your pension scheme operates using what we call the relief at source method, which, whenever you pay a contribution in, allocates basic rate tax relief automatically. So if you paid £100 out of your net pay today, you get your basic rate tax relief at source using the relief at source method, meaning you've got £125 invested in your pension scheme. Now, if you're a high rate taxpayer, you then have to write it off to the Inland Revenue at the end of the year, or you fill it in the tax return. But also it doesn't affect your national insurance. It's only tax relief that you get. Now, by comparison, salary sacrifice allows employees to give up some of their gross pay in exchange for a non-cash benefit. In this instance, it would be an additional employer pension contribution. Now, the main benefit here is, first of all, it reduces your taxable pay, which therefore means you pay less tax, but also it reduces your national insurance contributions. Now, this is a real benefit because it just increases your net take-home pay. But it also means that you no longer need to make a manual claim at the end of the year for tax relief if you are a high rate taxpayer. So we'll talk more about the detail of how this works, and I've got a couple of worked examples for you on the next couple of slides. But the key takeaways here is, by moving to a salary sacrifice structure, it will simplify administration and reduce your taxable pay, which means you have a higher net take-home pay thanks to the national insurance contribution savings. So hopefully that makes sense. But as I say, there's more information, and then if you do want any personalised examples down the line, let us know and we can help you through that process and make sure you have all the information you need. A worked example here on the basic rate tax. So this is looking at a salary of £36,000 a year or £3,000 a month. We've grouped it in the before column and the after column. So the before column is what you're doing now. The after would be assuming that salary sacrifice consultation went through and all passed okay. and we move to a salary sacrifice method from later on down the line in September, that's what it would look like then. So the demonstration here is under your current structure, you would have £3,000 a month of gross earnings, your £36,000 salary. If you then decided to pay in 5% of your salary as a member contribution, and there's the 10% of salary there from the company contribution as well, you would see £120 deducted from your net pay. So 5% of £3,000 is £150, but you'd see £120 from your net pay. £30 is then added as tax relief automatically by Aegon. The company add in their £300, so in total you're getting £450 a month paid in. Now, once all of that's happened and you've paid your tax or national insurance, your take-home pay would be in the region of £2,333 a month. Now, by comparison, looking at the salary sacrifice version or the after column, you can see there that the taxable earnings has reduced by that £150 gross. Now, that's quite an important structural difference here, because actually we're giving up salary in exchange for an additional employer pension contribution. And structurally, when you looked at your Aegon statement, you would see in August, for example, that you had an employee and an employer payment, whereas in September, if the consultation goes through and everyone's happy, then you would see one single employer contribution for the full amount. And that is how we make sure that the tax relief is added correctly. So your taxable earnings have reduced by that £150. That's still given the same tax relief because you're still a basic rate taxpayer, so you get the 20%, but also it's created an employee's national insurance relief of £12. So in this example, exactly the same contribution has cost you £12 a month less than it did before. Now that's quite a useful addition, bit of tax relief there. Go over the years, that will add up to quite a lot more going into your pension. And your options are, a lot of times people will say, well, I could increase my personal contributions from 5% to 6% maybe, and use that 12% into the pension scheme, or given cost of living increases, I will just retain that extra £12 and use that somewhere else for whatever else you wanted it to be. So hopefully it's doing exactly the same thing, the same amount going into the pension in this example, it's just costing you £12 per month less under the new structure of salary sacrifice. Rolling that forwards now into a higher rate tax example. This is based on a salary of £60,000 a year and therefore taxable monthly earnings of £5,000. Exactly the same process here. 5% is £250 and the 10% from the company would be £500, making £750 a month in total going to your pension scheme. So in this before example, the 5%, you'll see £200 deducted from your net pay. You'll then see £50 allocated by Aegon as basic rate tax relief, making that £750 in total, and your employee's net take-home pay is now £3,579 a month. Now, as a high rate taxpayer, you would be eligible to claim additional tax relief at the end of the year, but you would have to wait to the end of the year to do it, and you have to write a letter or do a tax return, or potentially change your personal tax code to account for that difference. Now, hopefully most people do that, and I know a lot of people do get the letters off us every year, but if you haven't ever done that in the past and you are a high rate taxpayer, please do let us know. It might be that we can go back and get some unclaimed tax relief for you, but under this new structure with salary sacrifice, you wouldn't need to do that, because you would get your full tax relief at source and also added national insurance relief on top. So looking at the after column there, we can see that your gross taxable earnings have dropped from £5,000 to £4,750. So that £250 gross pension contributions come off. That gives an immediate tax relief of £100, giving your full 40% at source through payroll, and an additional national insurance relief of £5. So you're still getting your £750 a month, but your take-home pay each month has risen by £55. So the pension's costing you £55 less per month in this example. So again, it's important there that you can see the differences in the take-home pay, and then you can either redirect that to additional pension contribution or have it in your pocket and use it for something more exciting, more fun, whatever it is you decided to do. Probably spend it on the kids, I suspect. So it's quite a good extra structure there. But the important takeaway from that bit are, if you are a high rate taxpayer, you won't then have to do a manual reclaim for additional tax relief. It will happen automatically. Now that does mean if you have accounted for the pension contribution in your personal tax code, you will need to undo that if this goes ahead, because you don't want to end up getting double tax relief that you then have to pay back later. Added benefit here as well, of course, if you are reducing your taxable earnings, particularly if you're on the cusp of higher rate tax or on the cusp where you lose child benefit, for example, using salary sacrifice and setting your contributions to the right level will help you get below that cusp, which might mean you get additional tax relief on top by not having to repay child benefit or family allowance and all this kind of stuff. So overall, it could be a really, really useful tool to help you mitigate quite a bit of annual tax. Now, I've mentioned the word consultation a few times during this presentation, and the process here is actually an employee consultation. So we're going to start off through July and August by presenting this data to you, giving you lots of information about how it's going to work, answering any questions that you might have, and giving you the opportunity to feedback your thoughts, queries, issues, problems, congratulations, whatever you think is right to be saying at the time. We also are going to do some on-site days, and myself as a member of the Warren House team, I'll be on site for the dates there, 3rd, 10th, 11th July, and also again in August on the 1st and 26th. And there are some late appointments on the 11th for those of you that do work later shifts. So please do reserve those, the guys that maybe aren't around during the day. I'll set those up on the booking system as normal, and then you can get in touch with us. And if you want to have a one-to-one chat about exactly how this will affect you, run through the numbers on a personal basis, answer any private questions that you have, let me know, get an appointment booked, and then we can have a chat through it, answer any questions that you've got, and hopefully make it all make sense to you or make it work as best as it possibly can for you. And the frequently asked questions documents will be issued as well during July and August, especially as we start to get initial feedback in. We'll feed those back as additional presentations in talking points articles, and we'll have some intranet articles as well. So keep an eye out for this information, have a good read of it, and then subject to feedback and the consultation hopefully passing through that July-August period, it would go ahead in the September's pay run. So you would see any changes there. And the initial plan would be that, assuming it does go ahead, that September run will be mirrored. So if you're currently paying 5% now, you'll still be paying 5% in the September run. However, that will then be on the salary sacrifice basis rather than the current basis. So you should see a seamless transition with actually nothing that you have to actually do to make that happen. That's why we're doing it as a consultation process. But if there are any issues, any questions, any problems, please do let us know, and we'll hopefully make sure we get all those answered for you in plenty of time and go on from there. Now, I've only really been speaking about the pros of the salary sacrifice scheme so far in this presentation, but there are cons. On the whole, hopefully there are relatively minor ones that shouldn't affect people too much, but I think it's only right that you are aware of them and can have a feel about whether or not they are going to be an issue for you. So the pros that I've already mentioned are additional savings via the national insurance relief, making your take-home pay increase for the same level of overall pension contribution. You'll get your immediate and full tax relief at source. That's particularly beneficial for high rate taxpayers. And also there is a reduced administration for the tax relief so that you don't have to write off or put it on your tax return. It'll just automatically get the full tax relief. So there are a couple of really good pros in there. On the cons list on the left hand side, the biggest one I think is going to be the less flexibility in the way that the scheme is managed. A salary sacrifice is deemed a permanent change to your employee's terms and conditions. So by definition, it can't be as flexibly changed as it currently is. At the moment, theoretically, you could have a monthly change to your contribution level. Under salary sacrifice, that's going to be a quarterly change to make it more permanent and more structured. Now, if you do have a lifestyle event, such as you get married, you move home, you have a child, you get divorced, you lose a family member, etc., that does open up an immediate window so that if you need to have an urgent change due to a significant life event, that is fine. You won't be held back from being able to make that change. It will always be at the company's discretion to make those changes for you, but those lifestyle events are really important and can be very dramatic. So you will always have that flexibility in there, have a chat and get those changed. But you won't be able to do it on a month by month basis. Ideally, and what we would normally like to see under any salary sacrifice scheme, is you set up your contribution for the coming 12 months, go through that 12-month period at that contribution level, reassess it maybe at the next pay review, and make any changes on a less frequent basis. That's part of the conditions of all of these kind of schemes, just to ensure that any national insurance savings are justifiable and well earned. So please do bear that in mind. It may affect some state benefits, and this most commonly would be in things that are means tested. So, for example, statutory maternity or paternity pay, where you have a period of time leading up to your the birth of your child, where your salary is calculated, and that then affects your maternity benefits, that can potentially reduce those slightly. Um, in my general experience, it doesn't make a particularly large difference, and the national insurance savings throughout the rest of your working life significantly outweigh the very small relative costs during that period of time, particularly with a company like Mercedes, where your maternity and paternity scheme is really quite good and quite generous. It shouldn't have any significant effect. And there will be more published on that because it is quite an important topic to get your head around. So please do read those guidance notes when they come out and see if it's something that is going to affect you. But again, hopefully it will be a relatively minor part of the problem if there is one. Another one here, contributions cannot take your underneath the national minimum wage. So if, for example, you wanted to either contribute a large amount to your pension, or you were relatively close to minimum wage, maybe because of the job role you do or the amount of time you're working for, you won't be able to use salary sacrifice because we're not physically allowed to break the law and move you under that national minimum wage structure. So the payroll software will automatically detect that. And if, for example, you're earning even £40,000 a year and you want to put in 60% of your salary, it won't let you do it because that would breach the minimum wage issues. At that point, your contributions would revert back to the relief at source method, whereby then it doesn't have the same restrictions. So if you are thinking about making particularly large contributions for a period of time, often that might happen, for example, if you're getting close to retirement, or if you're relatively close to those minimum wage figures, please do get in touch and we'll help you find a level that's right for you. It might be, for example, that you just use a salary sacrifice to the point where you're just above the minimum wage, and then also you can make personal private contributions outside of payroll to get you where you want to be. So there's a couple of options there that might work quite well for you, and we can just talk you through and figure out what those might be. The final piece there is the national insurance savings only apply to those under state pension age. And very simply, that's because over state pension age, you don't have to pay national insurance. So whilst it is a con, actually it isn't a con in a weird way because you're not paying national insurance. So you won't particularly benefit from the scheme from a national insurance point of view, but you will still benefit from it from the immediate tax relief perspective, particularly if you are a high rate taxpayer. So hopefully it's kind of a half con, half pro, if that makes sense. On this slide, I have a few frequently asked questions from various other schemes where we've worked on before and had similar kind of implementation processes. The most common one is, will this affect my mortgage application? So I've mentioned a few times here about how your gross take-home pay will be reducing by your pension contribution level and reducing that taxable pay. Now, this won't affect your mortgage application, and most mortgage providers nowadays look at your net take-home pay as the driver for your mortgage affordability. So because of using this process, you have immediate tax relief and also the national insurance contribution relief. Actually, your net take-home pay often increases slightly. So that should make your mortgage application more favourable. There are instances where a few lenders do ask you to opt out of the pension contributions during the application process to enhance affordability. Generally, we don't advise that you do that because often you might lose out on those valuable tax reliefs that you might not be able to recover in the medium term. But generally speaking, it shouldn't affect anything. All the mortgage lenders now are very comfortable with this. Most of them accept that it's a really modern, consistent way to make a pension contribution. It shouldn't affect anything. But if you do have any problems there, give us a shout and we'll point you to the lenders that are very comfortable with it, and all the mainstream guys are now. Second question there, will it affect future pay awards, bonuses, additional benefits such as life insurance? Answer again is no. On your HR file, there will always be a retained number called your notional pay. Now that notional pay is effectively your pre-salary sacrifice salary level. So if you're currently earning £40,000 a year and then you give up 5% of the pension, your notional pay will still be retained as £40,000 a year on your HR file. And that figure is what will be used for your future pay awards. Additional benefits such as the life insurance, for example, it's the notional salary figure that will be used for your future pay awards, etc. So no, it won't affect any of those future issues on that point of view. How could it affect state benefits such as my state pension? Now this is quite a common one, particularly because state pension is earnings related. Now in essence, you only actually need to pay an element of national insurance in a year to qualify for that state pension stamp for that year. I'm not sure if that makes sense. But you have to acquire 35 stamps through your working life to get a full state pension. But you only actually have to pay £1 of national insurance in a year to qualify for the stamp in that year, which is typically around about £8,000 or £9,000 of earnings in a year. So from that perspective, taking 5% off the top of your salary should not have any impact at all on your state pension. Provided you've paid a bit of national insurance, you will qualify for that stamp and you'll get your contribution for the year. The areas that it might affect state benefits wise are earnings related awards, and there are some that, for example, the less you earn, the higher the benefit might be. So it could be a benefit in that by having a lower gross pay, you might qualify for more benefits. It also could be the other way on things like statutory maternity and paternity pay, where you have a short period of time where they average your salaries in order to calculate your statutory benefits. So it might be slightly lower, but typically we're talking relatively modest amounts. And what you can always do, of course, is there is a quarterly review point where you can alter your contribution levels. So if you are potentially going to be having a child in the next 6, 9, 12 months, and you potentially therefore going on maternity pay, what you might decide to do is reduce your contribution down for a period of time at the next quarterly review, have those calculation periods, and then look to increase them again down the line. So there's always options around that. It's just something to be a little bit aware of in the background, and come and chat to us for a bit of advice if you get to those points where you need it. Now, what happens if you can't afford your contribution anymore? And obviously, you don't have to pay into your pension scheme. The very good thing about the Mercedes pension scheme is you get your 10% of employer contribution without the need to pay in at all if you don't want to. That will stay exactly the same. You don't have to start paying in if you don't want to. So from that perspective, if you do agree to a 5% contribution now, or 10% or 20% that becomes unaffordable for whatever reason in the future, then you will have the ability to amend that going forwards. It might be at the next quarterly review, or again, as I mentioned, if you have one of those life events where you've had a birth, marriage, death, etc., then those lifestyle events can trigger an instant alteration if you wish. So have a chat with HR. If any of that becomes an issue, have a chat with myself, and we will find a way to make this work for you as effectively and efficiently as it possibly can do. Can I pay more than the minimum wage floor? No, you can't, not using salary sacrifice. You can sacrifice down to just above that wage floor, and obviously that changes a little bit each year, so it might be a moving feast to a degree. If you do then want to pay in additional over and above that for whatever reason, you would need to pay that in privately outside of payroll, so that it didn't trigger that wage floor. And as a default process, as soon as you get close to that minimum wage, if the salary sacrifice will take you below it, the system will not allow it, and it will revert you back to the relief at source, which means you'll lose those national insurance benefits. So again, if you're remotely unsure where you're going to sit on that and how it's going to affect you, let me know. We can talk you through it and find the right level for you and make it all work. Do I have to use my Aegon pension? The answer there is yes. In order for this to work as a structure, there can only be the one pension scheme that it really links to through payroll for an efficiency, but also a pension legislation perspective in relation to automatic enrolment laws. So from that perspective, yes, you do have to use your Aegon pension to receive these contributions. Obviously, you can continue to pay privately into a private pension outside of the scheme if you wish to, and that often is the case if somebody wants a particular kind of investment fund maybe that's not available on the Aegon platform. And also you can migrate the assets from Aegon to another provider down the line if you wish to. You're not locked into Aegon once the money's in there. It's just the contribution method of progressing through payroll into a pension that has to go from you and Mercedes into that specific pension scheme. And where can I get advice on my options from? So I will be on site over a couple of times over the coming months to offer any advice there. Obviously, you're very welcome to find any other advisor you have. If you've already got a private advisor, anybody else out there, please feel free. If they have any questions that you don't know the answers to, or isn't in this content that you want to find out, let us know, and I'll happily liaise with them and get all the information you need to make sure that all of your private finances are considered and you're fully catered for and looked after. The final slide for today is a quick summary of what we've been talking about. And most importantly, there's nothing to do right now other than read the content, ask questions, feedback your thoughts, and please do contribute to the consultation process. And hopefully then we can make sure it's as personalised and customised for you as a group of individuals, and then hopefully you get the most benefit out of all these additional changes. More information and communication will follow, so please keep an eye out for those and seek any advice that you might need. The consultation process will run through July and August, and if successful, changes will be effective from September's pay run. So there's a couple of months before that goes formally live, assuming it does pass. So please do feedback any queries or concerns that you might have. A few additional useful links there. So information on salary sacrifice and pensions from Money Helper, which is the government agency built to give help and guidance around pensions. There's also a similar set of guides on Aegon's website directly, so it's kind of provider led from your pension provider's perspective. And also again a link to the pension portal there for Mercedes, where you can go on and find all this information. We'll keep that updated, and you can also find access to our contact details there, and also the facility to book your online appointments or your in-person appointments as you wish. So do please get in touch, ask any questions that you might have, and then we will hopefully get it all up and working for you in a way that will be really attractive and really effective. Thank you for coming today. So my name's Mike Savage. Hopefully you found this useful, but any questions you do have, let us know and we'll get things sorted out for you as best we can. Thank you.